Mehta. And first of all, let me thank you for accepting my request and addressing all our participants. The participants are not only our current students, but they are also alumni of IIM Ahmedabad, and also many people who are friends and acquaintances of our students and alumni. Basically, the invitation is free, and I request my friends, all those participants, all those audience of past programs to share the invitation with as many people as possible so that knowledge can be shared with each and every person. So that's how the profile of participants are. Sir, first, let me have this opportunity of introducing you to the participants, and then I would request you to share your knowledge and wisdom with them. So may I introduce you, sir, to the participants?
Please, thank you.
Dear audience, good evening to all of you, and a warm welcome to this 18th talk in our web talk series. I'm Sanjay Verma, professor at IIM Ahmedabad. Today we have amongst us Mr. Sunil Mehta. Mr. Sunil Mehta has a very, very rich experience of working not only in banking sector, but also in many other sectors. Let me share with you that he has worked for around 18 years in Citibank, and then he was responsible for AIG business in India, covering insurance, financial services, and investment. He had set up AIG's insurance joint venture with Tata, and he was responsible for AIG's presence across 10 businesses in India, which included life and non-life insurance, private equity, asset management, real estate, home finance, consumer finance, etc. I came to know about Mr. Mehta. I got introduced to him as he was chairman of Punjab National Bank, where he has recently completed his stint for 3 years as a non-executive chairperson. He has also been on board of State Bank of India. Currently, he's again chairperson of Yes Bank, which all of you are familiar with. And he also has started his firm, SPM Capital Advisors Private Limited, which is doing really very well. And Mr. Mehta is a very well-known person in financial circles, not only financial circles, but let me share with you, he's also associated, and he has been associated with many other activities other than his professional responsibilities. He was founding board member of Asia Society India Center. He has been board member and past chairman of United Way of India. He was a past chairman of Action for Ability Development and Inclusion. Formerly, that was the Spastic Society of North India. He has studied at Sri Ram College of Commerce, University of Delhi, long ago. And he's a fellow of Chartered Accountant from ICAI, an alumni of Wharton School of Management. In addition to what's written about him in various forums and what he has shared with me, I would share something more about him, which is not written anywhere, which is about his hobbies. He likes gardening a lot. He spends some time, at least daily, in his garden. I think his day starts with gardening. He loves traveling, and as I've interacted with him for around more than 2 years, I have seen how many places in the world he has visited. He loves food a lot, which I think we share a common likeness towards food. Other than that, all these, he's someone who knows where to use heart and where to use mind. You know, he distinguishes between when one should be strict and follow the rules and norms, and when one should be lenient and be more humane towards people. He distinguishes between these two, and that I think is a very important characteristic of someone who is very successful, very knowledgeable. I think if a young person has to get any mentor, then he's the right person, because he not only can guide the person in learning business, but also to improve personality. So, sir, I don't know whether you have done in past or not, but whenever you get chance, please do mentor. You must be doing that a lot, I know, but you should mentor many more people. Young people in this generation require a lot of mentorship from people like you. So, dear friends, this is Mr. Sunil Mehta, and today he is with us to speak on banking. All of us know, and all of us are associated with banking in some way or other. But what goes at the back, which makes banking so challenging, that's what we would hear from him today. Mr. Mehta, once again, thanks to you and a warm welcome. As you have requested and suggested, we will have this as an interactive discussion. As and when participants raise their hands or ask questions in chat box, I will bring it to your notice. There are people listening to this on Facebook also. When they ask any question on Facebook forum, I will put that to you. So that's how we'll interact and we'll make it more interesting. Sir, all yours. Thank you.
Thank you, Sanjay ji. It's really a privilege and a treat to be on spending time with you and all your colleagues, friends, and students past or present at IIM Ahmedabad. If I may request, the participants can put themselves on mute.
So I will be controlling from here. If by chance people are speaking in between, I will put them in mute, because to make it more participative, that's why I am not controlling everyone and putting everyone on mute.
I actually wanted to be a very interactive session, and I wouldn't call it a talk, but I'll call it a chat, and so that we can actually chat. And I do not have a presentation that I can put on the screen, because putting a presentation would be a dishonor for them, because they can do presentations much better than a chartered accountant can. So here, the topic for the day is the banking sector in India, current challenges and way forward. To come to where we are today, it would be important to give a little background of how our Indian banking sector has evolved. And I will try and cover also some of the other correlated aspects of Indian banking, which is basically the Indians' insurance and the securities market, as they are also co-joined at the hips. But if we go with banking, our entire banking in India is about 125-year-old evolution, starting from the State Bank of India's earlier roots of the Imperial College and the presidency organization that it was called. I forget the full name, but that was about starting about 125 years back. And our banking system has evolved, the formal banking system has evolved from there on. The changing point of our banking system was also when several large Indian banks were nationalized, which was almost 50 years ago. And that sort of changed the entire edifice of the Indian banking system, with the large banks being put as becoming state-owned banks, and some of the small private sector banks still being there, and with foreign banks having a continued presence in the Indian market. And then, of course, we had the cooperative and the rural banks, the RRBs. While this was happening, we also had the development financial institutions, which the IDBIs, the ICICIs, and the IFCIs, which were there, which were sort of helpful in participating in financing India's early years of India's infrastructure financing. We were living in a situation where it was by and large a controlled economy, and the financing of the bank by the banks to in a situation like that was much more regimented. It was not very market facing. If you were an industry or a company which had the benefit of a license or certain rights or mining rights that were resources that were being sanctioned by the government, whether it be at the center or the state, you enjoyed a certain amount of premium, which sort of obviously helped you in building your businesses and also servicing your debts, as the case may be, over a period of time. We were going through a situation where there used to be scarcity of capital and also scarcity of physical resources, which actually put a premium on both these two aspects of any business that was being built. Over a period of time, these restrictions were removed, and we moved from a controlled economy to much more of a market-based economy. And that change had a significant impact on the way our businesses were being developed over the last 20 odd years in particular. The real issues in our banking system started emerging in a significant manner. The signs of stress and strain, particularly in the last decade or two, started actually becoming more visible from 2012-13 onwards, when we start in a market-based economy. We all started witnessing a large amount of stressed assets or companies where they were highly leveraged, and the banking system had extended a huge amount of debt in the system, and they were really starting to reel under the pressure of being able to service debt. That consequences of that were started, in fact, becoming even more visible from 2014. And the challenge there was that in the banking system, that we had limitation of capital, or really a limited line of sight of capital, particularly amongst the largest component of the banking system, which was amongst the public sector banks. Because principally their ownership was from the government. So as a result, for any ability for them to be able to raise capital, it was also had to be considered whether the government wanted to infuse more capital, or the timing of that was a bit uncertain on many occasions. Hence, as a result, the capital raising took more time for the banks to be able to then fully determine of what should be the provisioning that they should be doing for the stress asset portfolios that were building up. And in a situation like that, it wasn't by any reason that there was a desire to kick the can down the road. It was by circumstances that we were in, that as a result, that many schemes had to be developed so that the banks could get some more leeway at what point of time they would sort of book all the provisions, so that they needed to completely reflect the portfolio quality at that point of time. So there were many new schemes that came in, 5x20, and all of those schemes that sort of came in to sort of help banks, make the provisioning at the appropriate time, and so that it is recognized as to what the real inherent strength or weaknesses of the system were, it just became a much more complex and difficult. Somewhere in the last 5 odd years, situation started becoming more challenged, and as a result, in 2016 there was the formulation of the IBC, which provided a new avenue for the banks to be able to put their stress assets for resolution through an IBC platform. By which time the situation had become quite challenged, and it just became difficult for the entire system to deal with the volume and also the size of the assets which had gone into a stress situation. Around this time was a question of the aspect of our own capacity in the banking system to deal with the complex issues which related to the risk issues and the issues on credit processes, governance, people who were relevant, who could manage those aspects adroitly, and from the point of view of finding stability in the leadership, where the banks could actually deal with not just the complex asset situation, but also develop a business strategy for the growth of the banking system in a manner that would be aligned to the growth of the economy, which was during the last 10 odd years before, I would say, was growing at a very good clip and we needed our financial infrastructure also to be aligned to that. We also had a challenge that over this period of time, where there was a huge amount of financing that was being done earlier by the DFIs, or the development financial institutions, they slowly started facing their own challenges, and they got morphed into banks, commercial banks. And as they got morphed into commercial banks, we faced a situation where, because of the nature of the financing that was required to be done, the whole aspect of the asset liability mismatches started coming to the fore of how do you finance a project which requires a 20-year financing, where the bank's ability to raise liabilities are not of that tenor, because they are typically, apart from capital and the other ways of raising long-term liabilities, they're typically dependent on deposits from retail and corporate customers, where the tenures are much lower than the ones that they are required to finance from the infrastructure perspective. So these complexities all came together, and as a result, the entire banking system, there was a stronger review of what needed to be done to be able to align itself with the changing market conditions, and then prepare for the system to improve its governance and risk and credit processes, and to be also use technology far more effectively, so that they are future ready. While this was being considered, the several issues came up in the banking system, which created significant problems for the banks over the last 4 to 5 years, where the certain banks were strained. Some major governance issues came to the fore. There were some large frauds. There were some glitches in the cooperative banks, and all of this kind of forced the entire ecosystem to revisit what could be also a revised regulatory architecture, which needs to be looked at from the point of view of our entire financial system, including the banks. And we are actually at that crossroad. The COVID-19 situation added to provided an overlay of a complex financial system that we were attempting to deal with. And then over the last 3 months, the COVID-19 actually really put the whole situation in such a position that today we have no other option but to entirely revisit on many aspects of the banks. And this is what I'm going to deal with for all of us to view as to what could be the outlook of the banking system here on. So let's start with the aspect of governance. The governance piece that was, as I said, was pieces that did not help in the development of where the banks had to go, or from the clients that they were lending to. There were certainly many issues on the quality of the governance on both sides of the divide. And this aspect became more and more relevant, which had to be fixed because the governance at the borrower's end led to, in many cases, an integrity issue, led to some inappropriate and irresponsible borrowing, and also from the banks that they had actually lent to the extent they did. The issues about their total debt to equities had reached an unsustainable level. And there was also, when the economy was booming in the past, they diverted their funds from the purposes for which the banks were lending to other kind of businesses, which when the economy sort of started to slow down, those businesses went into a significant amount of difficulty, and hence their inability to pay back the banks. Now, with that backdrop, the government and the regulator, which is the Reserve Bank, has started focusing significantly on enhancing the quality of the governance in the banking system. This issue has been discussed enormously, including there was the PJ Naik committee report, which was between around 2012, 2013, which actually articulated that the entire banking system, particularly in the public sector banking system, there needs to be a deep review of what kind of governance structures that we need to have. This is a long pending issue, and I think one of the most critical ones that need to be looked at, so that if we can get our governance structures right, in my view, many of the problems that we have faced in the past will be attended to based on high governance standards, and also make us ready in terms of how we need to deal with a very complex situation as we see banks need to service from a post-COVID era. The Reserve Bank of India has recently issued a document which sort of very comprehensively articulates many different potential changes that may be done on the way the banks are governed, and this crosses covers both the public sector and private sector banks. And I think it is for the first time that I'm seeing such a comprehensive paper coming out, and really a paper that could have significant consequences in the way the banking will be done going forward. This is, I would say that over the next 3 to 6 months, if the Reserve Bank and the government is able to arrive at a final document on the basis of which banks will need to be governed, and that includes both public sector, private sector, and hence extended to the non-bank finance companies, I think we will be at least on the basic foundation of our, and the trust and the confidence in the banking system will change dramatically. So I'm very hopeful of different people applying their minds and providing their inputs to the Reserve Bank of India in a document that shall be formalized in short order. So review of governance standards is probably the most important priority. Second, if we look at the situation now, what the banks are facing, we were already facing headwinds of the economy before we went into the COVID situation. There is an urgent requirement. While the government and the Reserve Bank of India have taken several steps to deal with the immediate issues which the Indian economy or the industry is facing, particularly at the MSME sector and the economically disadvantaged. There is a lot that needs to be done to recapitalize the banks, to make them be fully ready from at a stage when post-COVID, when we see what the full impact of the sectors that get affected, and we don't need to get into the individual sectors. We all know the sectors that have got affected and will take some time to recover. There is a large amount of assets or exposure of the banks in those sectors, and we have to find solutions, or we will need to figure out a certain amount of provisioning that the banks will definitely have to do over this period, which is going to be towards the latter part of this calendar year and first quarter of 2021, which is in the current financial year. And we need to ensure that we have adequate capital in the banks to be able to deal with that, which means that there will be, we will need to access capital both from private markets and including infusion of capital from the government over a period of time to make sure that whatever capital or ownership they want to retain in the public sector banks, they will be able to do so going forward. The same issue of capital will need to be attended to as far as the non-bank finance companies are concerned, and also in many cases the cooperative banks. We cannot allow our system to be frayed or be frail at the edges, because any derailment of any institution, small or moderate, has a huge implications or impact as systemic challenges for the entire system. So safeguarding and protecting the entire banking system is, I'm quite sure, the regulators' prime that they're focusing on that and really wanting to ensure that there are no individual NBFCs or institutions that face real difficulty or lack of public trust. And because there's so much of issues in the marketplace, some rightly, some wrongly, and dealing with all of that is absolutely critical for the regulator. The entire risk governance piece is going to go through a real evolution here. We had in the banking system risk management practices to look at the entire portfolio that we used to look at, from doing scenario planning, doing sensitivity analysis, to see how strong or how weak the portfolio of the bank is. I doubt if any bank or financial institution was in a position to do a a sensitivity analysis of the order of what we are actually facing today on account of this COVID-19 situation. It is really uh, teaches us that when we do a sensitivity analysis in our when we're reviewing our portfolio, it becomes so important for us to look at worst case situations. As a practitioner, whenever we used to do as the chairman of the risk committee of the risk management committee, we used to do this portfolio analysis. It was mostly the case that on three scenarios, scenario A, scenario B, scenario C, we would typically tend towards a scenario A situation because we had not seen scenario B's with any kind of frequency in the past. And the scenario C, which would have a significant impact if we were to take those into account for our capital requirements, were also sort of not taken with that degree of seriousness. Going forward, it is absolutely imperative that on the building of our portfolio of any bank, we will need to do stress testing of the magnitude that we have never done so in the past, which will mean automatically that from a prudent risk recognition, our capital requirements based on that scenario analysis will also change. So from whatever are the regulatory, and I'm sure the global regulators will also sort of revisit what were the requirements earlier and see in terms of the cushion that may be required for the banks to maintain for such kind of contingencies as we are witnessing today. Our credit processes. This is something that has really, I had found that we needed significant improvement in our credit processes, where in terms of credit evaluation of credits, particularly the complex ones, we perhaps should have done a far more cash flow based development of our credit exposure than purely based on collateral. When the economy goes through a downturn, the values of collaterals drop dramatically. So as a result, it becomes so critical for lenders and the banks to do a very strong scenario analysis on the future cash flows of the organizations that we are lending to. And this would be something that most banks are now reorienting to do a cash flow analysis than purely on the collateral available. One of the biggest changes that I believe that our entire banking system is already witnessing, and we will see that going forward, is the use of technology and the digitization. Way back in 2014-15, when the government asked the banks to take this initiative of opening the Jan Dhan accounts, I was on the board of State Bank of India. And it was, I have to admit, honestly, that at that point of time, we did not fully comprehend the entire benefits of this initiative that had been undertaken by the banking system. We were also concerned that this initiative may entail significant costs, and where would we be in a position to bring in whatever money was being spent on this big drive of opening millions and millions of new accounts. we look back and see that that initiative has actually provided new accounts to about close to about 400 million, or even more, I believe, as they sort of continue to grow, which is one of the biggest initiatives which we will see over a period of time as a transformation in the Indian banking system. Being able to reach the unbanked and also at the marginally or the economically disadvantaged who did not have access or were not able to be part of the formal financial system, to reach out to them in that size and magnitude has been absolutely phenomenal. Not only has it helped in reaching out the uh, the entire bottom of the pyramid, but the banks have also benefited because whatever they were getting as direct benefits transfer, those savings have accumulated, and the banks have benefited immensely by the balances that exist in those Jan Dhan accounts. Secondly, the entire digitization and the technology that was being encouraged for the banks to sort of adopt to be able to not only reach those account holders but broadly uh, enhance their digitization uh, infrastructure. I think if you look at what happened during the demonetization and today what we are facing today in terms of physical cash not being available and you have to sort of pay for your groceries through different kind of applications or payment mechanisms, the entire digitization infrastructure will has been a great boon for India's banking system. Um, Third, the aspect about data. Uh, the banking system is now sort of has been collecting data and has customer data, which some banks had organized themselves to be able to capture it effectively and use that data through a data lake or using data analysis or analytics to be effectively market new products and services to the customers. Uh, this aspect is going to be a transformational aspect as we move forward. Of course, there are issues about storage of data. There is an issue of data privacy. There's an entire issue about cybersecurity aspects that are going to, that we are going to sort of have to deal with. So there are all those aspects that any bank will have to be fully prepared. But between technology, digital initiatives, effective use of data, and the new delivery mechanisms that are going to be developed to the customers for faceless banking or call it non human contact banking, they are going to be actually catapulted. The momentum on that is going to be catapulted based on the situation that we are facing today. Customer expectations are also changing. Customers today are no longer willing to wait for getting whatever or completing whatever transactions that they were doing so in the past. So as far as instantaneous connectivity with the customer or being able to sort of turn around and improve the turnaround times, whether it is the applications for loans or it is delivery of new products to the customers or delivery of transfer of funds, all of this is going through such a sea change, which is at an amazing pace. So the difference, the walls between banks, telcos, and fintech players are actually breaking down. And along with that is really the payment systems and the APIs that are sort of being developed for developing a full seamless system, which I think is going to be of a magnitude that a lot of you youngsters will be able to kind of almost expect that this is the way the new banking is going to be delivered to you. To deliver all of that, I have deliberately not touched upon one thing which I wanted to leave for my last 2 points as I move towards my concluding comments before I open it up for question answers. With all this that is happening, challenges, issues, new opportunities, reorientation of the banking system, our delivery mechanisms, our risk mitigation methodologies that need to be adopted, better quality governance. I did not touch about the most important aspect of who is going to make it happen. It's the people. It's really the talent pool that will be required to not just look at it what banking used to be as traditional banking in the past, but this is going to be a, a completely different way of banking, uh, which is which will be uh, which will be uh, faced, or I would say, which we will all be part of from the economically advantaged or the upper echelons, the economically disadvantaged or the bottom of the pyramid. As you can see that everybody has today a mobile handset, and they are using that effectively for not just being up to speed on what is happening in and around them, but even for their financial transactions. So the expectations from the customers will change. Our entire risk architecture is changing from a traditional risk architecture, which was paper-based, to a digital architecture, which has its own sense of the own issues and risks. That'll change. What is it that we need to adapt? I think the entire people or talent pool that is going to be running this new institutional framework or the new financial architecture, they will need to be ready and adapt to change. No longer would it be that we as a board can develop a business plan or a business strategy in participation with the management and believe that that would be a static document which would be there for a 3 or a 4 year period. I expect every quarter for the boards to review with the management and see exactly what is going to stay in the direction or the line that we had already agreed upon, and what changes may be required for that are absolutely imperative for us to be able to deliver to our customers and discharge our fiduciary responsibilities and protect the interests of the bank. So the quality of the people that staff these institutions in the past, I see that there will be a sea change in terms of what would be required for these institutions in the future. The second, the other aspect that would be of critical importance is the aspect of ESG, environment, society, and governance. Governance I have covered, but the entire aspect of environment and social are now going to be built in to the banking system as key priorities. This was like the way we did any other business earlier in looking at what would be the carbon footprint from a business point of view. Now there will be a lot of consciousness that will be there in our entire financial system and banks as to what is environmentally friendly and what is not environmentally friendly. What is going to build sustainable communities or what is going to be detrimental in building sustainable communities. So ESG is going to play a very important role, and that's going to be part of the new banking. um, uh, it's going to be embedded in our banking system. The last point is where I want to sort of say is that to enable all of this to happen, we will also need to revisit our regulatory architecture and infrastructure. Banks, financial institutions, and insurance, as I said, all of them which are interconnected will need to have a, a regulatory overview or an infrastructure which is also in a position to change and see what are the practical issues and realities on the ground and evolve with those market changes. The current COVID situation has not helped, where there seems to be a breakdown or at least initial reaction of global institutions facing immense pressure from the local or the nationalistic requirements of different countries. We had the way the entire banking system has started post the Second World War on the Bretton Woods platform. I am quite certain that we will need to once again revisit what kind of regulatory architecture that will be required to ensure that both supervision and the framework based on which we develop the banking system going forward will also have to change. Regulators will have to be conscious that there are practical issues that the banking system will face on the ground if the regulations do not keep pace with the practical requirements or demands on the financial architecture, then I think we will again have some disconnects that will sort of impair the growth of the banks. I have seen very strong signs of the regulators responding to this change in the current crisis and in the past. So I am very optimistic that the regulators will take all necessary steps to ensure that this system is protected and this system is fostered to grow at a pace to meet the requirements of the customers, of our economic growth, and also to build the best of governance standards, to harness technology which is interconnected between the banks and the regulator, so that the regulator can have online review of what is, from a supervision point of view, of what is happening within the banks, and that the surprises that come up from time to time are minimized, are able to sort of develop very strong risk management systems, cyber security, which is going to be a new major threat, as I had mentioned, and also look at how the quality of the people who are managing these institutions are discharging their responsibilities. So this is where the system is, the banking system is today. But given the responses, as I said, that is happening already to deal with this, I am very optimistic of a development of a banking system that is going to be far more robust and far more future oriented, far more protected of all the bigger challenges that we will face. And a crisis like this will be used as an opportunity to make us completely future ready. So I will stop here, and I'm happy to take questions from the participants.
Thank you, Mr. Mehta. Thanks a lot. It was really very educative. Let me read the questions. Some of them are in the chat box, and some of them I would be reading from Facebook. So let me start with the questions that are in chat box in Zoom itself. And there is a question about bad bank, and someone has asked the question that, if we have a bad bank where all bad loans are maybe passed on to this bad bank, and the other banks are basically free of the load that they are carrying, so they want your opinion on this.
So thank you for this question. Since I was personally involved in the Sashakt committee report when I was chairing that committee for setting up a Sashakt asset management company or an AIF, I'm happy to respond on that basis. So, what had happened was that there was a large accumulation of stress assets. And in 2018, when we sort of saw that there were totally about, at that point of time, from a public sector bank's exposure, there were about 15 lakh crores to about 16 lakh crores of accumulated stress assets. And what we had suggested was that there would be different levels of how this stress assets could be dealt with, which was some partly relating to SMEs, which the banks can deal with them on their own, because the total exposure size was much lower, and the one-time settlements could be done in a manner that there is no look back, and people shouldn't be asking questions about what was the motive and why you sort of settled at that price itself. Then there was the larger corporate exposure, where we had suggested that these assets move away from the banks into an AIF and an AMC, and that the movement of these assets would be at a fair market value, which would be based on a Swiss auction or a manner that is determined that this is the best value that the banks are getting for these assets to be transferred. And we did not call it the bad bank. I think it's just a question of a nomenclature, what you call it. So the structure is to allow banks to, and this would be a bank-led resolution mechanism, which required banks to get together and develop a consensus that these assets, where they all have an exposure to, can be moved. And for that, we had suggested the banks sign an intercreditor agreement, which fortunately initially was voluntary, where 35 banks had agreed to do so. But now it is mandated based on the June 7th circular of the Reserve Bank of India. Now it is mandated. So for resolution of stress assets, that in any case, so you have two mechanisms. One, that you can move these assets into the IBC, or you can come with a bank-led resolution and you can move them out from that system. The recent IBA-led recommendation was almost in line with what we had suggested earlier, and it may be termed as a bad bank, or it may be termed as a repository through which this goes into an AIF AMC structure. I would prefer to call it that way. And if that is still in consideration, I think it's a good way of allowing the banks to move these stress assets out of their books and be dealt with by professionals who can turn around these assets, and subsequently the banks who have also moved these out can get some upsides over a period of time. This is a process which is quite prevalent right across the world. Post 2008, it sort of certainly, we saw many of these such structures in different markets. And I would certainly believe that in India itself, in whatever form this suits us locally, which must have the right governance structures, that is certainly a possibility.
Okay. There is a question related to mergers of bank which has happened in recent past. So they want to know some positives and negatives about the mergers that have happened?
Well, this has been a government's desire to build banks of size for a considerable time. And I think the desire of the government to move from uh, multiple small banks to fewer large banks is absolutely right. The important thing is to make sure that the consolidation or the amalgamation or the mergers, as the case may be, is done in a manner that is provides effective synergies and benefits as we move forward. We have seen several uh, um initiatives of this in the past with the consolidation of the State Bank of India subsidiaries that were rolled up into State Bank of India, the affiliate banks that were there of State Bank, associate banks of State Bank of India, then the banks that were merged into amalgamated with Bank of Baroda, and more recently the 4 initiatives that were undertaken by the government. I would say that steps in the right direction, but a lot of hard work, a lot of work needs to be done to ensure stability, to ensure the customer delivery does not get affected, to ensure integration of technology systems, dealing with people issues, and to make sure that our risk and credit processes are further strengthened. And of course, I cannot re-emphasize the importance of a governance structure over and above that to make sure that all of this happens in a time-bound manner and the way the board sees as beneficial to the entire organization and to all its stakeholders.
Sir, there are 2 questions from Facebook. So one is about Islamic banking and its potential in India. And another question is about the bad loans. And sometimes people think that it's also because of incompetency of people working in banks, maybe because of their inability or maybe technology challenges. So these 2 questions are coming from Facebook.
Well, on Islamic banking, there had been many initiatives in the past uh, to make sure that we can create the right kind of an Islamic banking structure here. The structure, as you know, in Islamic banking is quite different from the interest perspective. It has not really, and I'm not really an expert on that as to why I haven't done a full root cause analysis as to why it hasn't sort of picked up of the size that it should have. But I would still say that given the success of that in different markets in the Middle East, that we should certainly relook at it and see exactly as to how it can be done in the Indian market as well. On the second piece was relating to the people issues on bad loans. Uh, you're absolutely, or the gentleman or the person who has asked this is absolutely right, that the the issue really is how do you enhance the skill sets of people who are responsible for evaluating complex credits. One is on the basic issue of understanding A, the economic environment, B, the sector where you're lending to, C, the individual exposure that you're taking, and D, in terms of making your own independent assessment of the governance and the integrity of the promoters and the people you are dealing with on the other side, apart from sustainability of the business. So, I have spent years as a senior credit officer at Citibank and then my roles in SBI, PNB, and now Yes Bank. These are skills that you hone over a period of time as people who've sort of gone through many credits. You do make some mistakes. It's natural and part and parcel of banking. But I think your experience and your skills continuously need to be enhanced to make sure that you do a better credit evaluation. I am from the school that I did not believe in dependency on purely on external um, reports of risk rating of agencies, or different kind of rating agencies who sort of publish these reports and what the rating is, because some of these ratings typically lag and not lead. So as a banker, you have to be very proactive in your assessment of what are the developments that are taking place in any credit where you have an exposure to. So you have to be nimble footed. You have to see exactly how you can rationalize the exposure and engage with the borrower of what your objectives are in terms of, or your concerns are, and how you bring in the risk mitigants. So this is a broader question. It's not just that always relates to people's integrity at the lender side. It's a combination of many aspects. Yes, there have been instances where there are issues of integrity, but I think the number is still small on that front, and that constantly the banks need to be far more watchful and ensure that we generally improve the quality of our people who are dealing with credits of complex nature.
So there is a question about liquidity at banks. One person from on Facebook has asked that there is so much of liquidity available at the banks, and what should be their strategy to manage this cash availability with them in the given scenario?
Yeah, so a very good question. So it's a very interesting situation. There is a lot of liquidity in the system. If you look at it globally, I don't have the numbers as of 5 p.m. on this Saturday afternoon, but it's a number that is growing. With $6 to $7 trillion of liquidity that has already been earmarked or being infused or being released globally. So, and of course, what the liquidity that has been already released in the Indian ecosystem, there is a large amount of liquidity. The unfortunate piece is that the liquidity is getting trapped. There is a fear psychosis, and hence nobody is releasing liquidity. So the general mantra that everybody says is, do cost reduction, keep liquidity to yourself. If everybody keeps liquidity to themselves, how does the entire ecosystem come back in revving up the economy itself? So the first thing that we have to do is get rid of this paranoia, and the deep paranoia and the fear psychosis that has been unnecessarily built. There is a structural issue. There is temporary issues. I was just reading a very detailed presentation on listing down companies or sectors that are affected. But many of them are also reinventing themselves. And I think that is the best that comes out when your backs are to the wall. And as they reinvent themselves, the way businesses are going to be done is quite different the way we were doing it in the past. So my view is that once the whole aspect of fear keeps ebbing down, liquidity will start flowing. Initially, when this whole thing started, people ran and there was a flight of liquidity or a flight to safety. Now, as you see that there's so much of liquidity that has flown into some banks or institutions that they're actually putting the money back with the Reserve Bank of India at completely ridiculous reverse repo rates. So my view is that the entire water will find its own balance, and this liquidity will start sort of slowly flowing back. And as the confidence in the system also comes back, as people start moving back into their day-to-day economic activities, I have a confidence that this liquidity will start coming back into the entire system itself.
So there is a question about these cooperative banks, and in recent past, the way the things have happened in COVID in cooperative banks. So
yeah, I think that's a very unfortunate. you see, the entire regulatory oversight, as I said, one of the most important imperatives that we will see emerging out of this crisis, that were actually, there were signs of being, even when we had the economic headwinds in late 2019 and early 2020, that there was really a need to revisit our kind of regulatory oversight and supervision of the cooperative banks. My sense is that the Reserve Bank is looking at this very carefully. Between the government, then the state governments and the regulator, they have to find a solution that the cooperative banks are brought into the fold of supervision, just as the rest of the banking system is. I think there needs to be some consolidation there as well, by having the volume of cooperative banks that we are having today tends to somewhat dilute the supervision that may be available for all these institutions. It is good for everybody that these banks, cooperative banks, are well supervised and well regulated. It is in every interest, including the depositors and their promoters and stakeholders' interest. So I am quite sure that over the next 12 to 24 months, we will have a much more well supervised cooperative banking system.
So, sorry to interfere. So, Verma ji, I'm sorry, I just need to ask a direct question related to cooperative banking. May I know, sir, if after COVID and this challenges what we are going through at the moment, what do you personally think about cooperative banking future?
So I just covered that cooperative banks are part and parcel of our integral banking system. They are there. They are in huge numbers right across the states. They have been an integral part of our financial system. I think the cooperative banks will continue to be there, but I'm very sure that these banks need to be well supervised. We need to ensure that there cannot be any inappropriate activities that we have seen in the past. Ultimately, the poor depositors lose out on this. So a lot of attention needs to be paid as to how we can create a regulatory architecture to bring them into that supervised financial system, so that whatever has happened in the past, those issues are minimized, and completely over a period of time, we do not see those recurrences.
So there's a question about neo-banking concept, which people are talking about in these days.
So I alluded to that the entire banking architecture globally is changing so rapidly. It is a phenomenal piece of sort of, as I said, that boundary lines are getting completely blurred between the way different fintech companies are going to play a role in what you can call them neo-banking, or you can call them the new generation banks, or whatever you want to sort of treat them as. But even as part of the entire traditional banks that one has seen over a period of time, from both foreign banks, private sector banks, and the state-owned banks that I've sort of had the privilege of engaging with, I can see a very strong evolution that is taking place. If you don't board the train of becoming part of that, I'm afraid that these banks will still be standing on the platform and may find it very difficult to board that train, because the train is already either leaving the station or left the station. So using technology far more effectively, and this is not just coming from the large global technology players. Some solutions are being found by young entrepreneurs, young people who have found some fantastic solutions, and new APIs are being developed. and new platforms are being developed for delivery to customers. It is actually a phenomenal change from the day that we were sort of looking at, even just to give you an example, when we as Citibank, we started our cash management system, we used technology far more effectively, but we leveraged the platforms of public sector banks because they had the entire distribution platform where the checks had to go for processing in different locations, and we were able to cut the cycle time. Today, the same banks who were actually being used as from the foreign banks can access technology which is available off the shelf, and do what they were sort of somebody else was sort of doing based on their platform. So my view is that all of this, look at all the Paytms, the phone pays, the new payment systems, Google Pay. Now even the fellow who you go and buy your eggs, he doesn't want a cash. He wants you to pay on the mobile phone. He does not want to touch your cash. He's wearing a gloves. He'll give you his 6 eggs, but says, I want transfer on my system. There's an absolute revolution that is taking place here. And this is all across, not just on payment systems, but right across the system. And this is going to be, call it the new bank or the neo-banking.
Sir, there is a question which says, I will just read it. Do you feel moratorium interest waiver will add, okay, somewhere the, so about it was about interest waiver, yeah, add to concerns of banking sector as there will already profitability wiped out on account of higher provisions in this financial year, and interest waiver will add a nail to the coffin.
I will not sort of certainly, I'm not in agreement with the last statement, but it certainly does add to the challenges. There's no question about it. That is the ecosystem that we are dealing with. There is no doubt that we are going through a difficult period. I had mentioned right in the beginning that it is incumbent on the banks that we need to raise capital. We need to be ready for some of the challenges that our exposures we'll see over the next 6 to 9 months. Yes, that will sort of add some degree of a difficulty, but if you do not have strong borrowers or healthy borrowers at the end of the day, you will only have a weaker banking system. So it's important for the borrowers also to emerge from this challenge situation, and there needs to be some degree of leeway given to them, and the banks need to be fully prepared for that. And I think, as I said, in 21-22, we will find this whole financial stability emerging from whatever steps are being taken today.
Sir, there is a question on future of NBFCs also, and secondly, I wanted maybe to avoid, if you wish, you may choose to ignore. There is question about Yes Bank and maybe what happened and your plan for the future. This you may take, or you may, like, if you want to avoid it, you may do that.
I respect every question, so I will not duck any question. So, but let me first, the first question was?
NBFCs, it's on future of NBFCs.
Yeah. So I think as I mentioned, that banks, public sector banks have their own set of challenges. Private sector banks have had their own set of challenges. There is no segment of the financial system which obviously has not faced its due share of challenges. And NBFCs have also, they were facing challenges, as I said, when the headwinds of the economy were there. And then there were some issues. And then, of course, the COVID has added some more, added another layer. What is important for the NBFCs is to have the right kind of capital, to have the right kind of risk processes to be able to get through this period. And what was important earlier, and I say this now, some of the NBFCs got challenged because of poor governance. I keep repeating because the piece of governance keeps coming back, that if your governance standards are strong, you can deal with many complex issues. People are willing to still give you a second chance. But when they see, when the tide starts ebbing, it's those NBFCs with poor quality governance who face much more serious challenges than the ones who've got better governance structures. So I am very confident that as they have learned their lessons and they improve the governance and their risk management and their risk processes and their exposure strategy, that will also change. There was also a state of euphoria when many investors were sort of coming in and putting capital, in some of these NBFCs. And, the price to book at which they were entering were completely out of sync with what could be the issues that those NBFCs could face. I expect that there would be some more sense that would have come out of this kind of a scenario for people to be much more uh, conservative and not sort of throw money where it is not supposed to be thrown. And they will come out much more stronger by doing the right things and dealing with their exposures in a much more judicious and prudent manner as they go forward. The next question was on Yes Bank. Yes, there is nothing to hide. We did have a set of issues that are in the public domain, and because of those issues that we faced, the government and the regulator, in participation with key anchor investor banks, they came in with a restructuring package and set in motion a new board and a new leadership, and they provided very strong support for the bank to be resuscitated and move ahead from here on. I can say this as the chairman of the board that I like driving my car by looking at the windscreen and not the rear view mirror. Whatever had happened has happened, but I'm very, very pleased to share that as we see the developments that are taking place within Yes Bank in the short period that we've been at the helm, the new board and the new leadership, with the existing management team, we are building a bank that will be ready, and we will discharge all our fiduciary responsibilities to our stakeholders. The bank is far more stable. The bank is reinventing itself, and I feel very comfortable in terms of the progress that has been made so far.
Sir, Ambrish Mishra ji has asked a question. I'm taking name because both of us know him. His question is about the duration of leadership in PSBs. He says, of late, the tenure of many MDs has been limited to 2 or 3 years only, which is not enough to bring about long-lasting changes and its impediments to good and consistent governance. Don't you feel that there is a need of increasing the age limit of whole-time directors in government banks?
I think Ambrish ji will probably know my response, and he's still asking this question. I'm a strong believer that the leadership tenure of PSPs must be increased. You cannot run these complex organizations with tenures of 2 years or 2.5 years. They must get a longer tenure to be able to provide a very strong, stable, and develop a vision of the bank and of course be able to sort of change these large ships that they are the captains of, and sort of get them to be future ready and compete in a very, very aggressive new marketplace, and also deal with some of the legacy issues that have been there in these institutions that need to be dealt with expeditiously. As far as the age limit is concerned, I believe normally the PSB's CEOs that I've seen are vegetarians, but their vegetarian diet is as healthy as their counterparts in private sector banks. So there is no question about, I'm a believer that their age limits should be also increased, but I would leave that to the government to decide.
Thank you, sir. There is, I think there are still a few questions, but I think we have to end at some point of time. So overall, a very fundamental question: how do you see future of banking in near future and in long-term future?
You know, I look at it that having spent almost 37 odd years in this, when I started my career with Citibank in 1983 to now, I couldn't be more excited about this as to the inflection point that we are in reinventing ourselves. And I say this not just for the banking system, but the entire financial architecture. You know, it is unfortunate that most tough decisions are taken when we have our backs to the wall. But that is the nature of the beast. That is the way all global democratic frameworks work under. And we are no different to a large, vibrant democracy, which has very different constituents and views on any matter. So I think we are now at that situation that if we do not change, we will not be able to deliver the future to our next generation of having a financial backbone, which is so important for India's economic growth. There are many different aspects of our financial architecture which needs to be fixed. I cannot but overemphasize that. But it does not mean that it is broken. It means that we have to see read the future and be prepared. I am so excited that the outlook of the Indian banking system and whoever, including some of your young students who will emerge and be part of this ecosystem and may choose this line as they sort of develop their professional, as they exercise their professional choices, I would say it is one of the most exciting areas. There is the aspect of regulatory infrastructure, which is related to public policy. There is the whole thing about governance. There is whole thing about technology, whole thing about risk governance, risk management issues, people issues, market access, data, how do you store data, cyber security, whether you should have bitcoins, you don't have bitcoins, you have, the whole world is moving. This is the backbone of I am so excited about it. I think whichever way, we will come out as much stronger and leaner. And I would encourage your students to believe in that, because they will benefit by exercising the choice to be part of this ecosystem going forward.
Wonderful. Thanks a lot, sir. Thanks a lot. Thank you once again for taking time from your schedule and coming to us and addressing our participants and friends and well-wishers. I am really very, very humble that you have come. I feel so nice. And I hope in future also you will give time to us, so that we learn even more from you on different topics of importance.
Thank
you, Sanjay ji. Greatly appreciate, and I also want to wish all the participants and thank them for being there. But I also want to wish all your students who are currently part of your who are sort of looking at the world from their oyster in IIM Ahmedabad, that this is a much more exciting world, and we may be going through some challenges, but they need to be the future batons, carry the baton of this in building a much better system. So we rely on them, and also the good advice and guidance that you as your faculty members provide to them.
Thank you, sir. Thanks a lot. Thank you. Thanks to all the audience, please, participants. Thanks a lot to you.
Thank you.
Thank you, Mehta ji.
Thank you, sir. Thank you, sir.
Thank you, sir.
Thank you. Thank you.
Thank you.
Thank you, sir.
Thank you, Sanjay sir. Thank you so much.
Sanjay sir, thank you really very much. It was nice
Thank
to see you, sir. Thank you.
Thank
Thank you so very much, sir. Thank you.
Thank you. Thank you, sir. चोपड़ा साहब नमस्कार और धन्यवाद. आप म्यूट पे हैं चोपड़ा साहब. But
Sanjay sir, thank you so much.
Thank you, sir.
my
Thank you.
pleasure, sir. Thank you. Thanks a lot.
Thank you, sir. Verma sir.
Thank you.
Yes, sir.
हाँ यार दिख गया होगा पर अनम्यूट रहा ना वो वीडियो बना ऑन नहीं किया था.
Can you hear me now?
Yes, sir. Thank you, sir. Thanks for coming.
Very
Thanks
much,
for your...
very kind. I expected more from him on Yes Bank.
Oh,
Okay, because there is so much is already said on Yes Bank.
yeah, it's okay.
I must add to what I said just now with great respect. He shouldn't be driving today without the rear mirror. You got me?
Yeah.
He has avoided the question.
Sir, the point is that he has said so much on Yes Bank on so many channels anyways that this would have been written of, so many things already available. That's why I didn't want discussion to move around Yes Bank only.
Yeah,
It's in
agreed, Verma ji, agreed. Or you could have gone to a different parameter altogether. Agreed. We stick to the topic. It was done very well. Sorry to interfere.
And
It
of
was
course,
done really well, sir.
excellent.
Yeah. And many problems, like in general, we know, but it's important to know what goes on and what is the vision of people who are deciding. So, but anyway, sir, thank you, and please keep on coming on this channel.
Very kind, sir. Thank you.
Thanks a lot. Thank you. So, everyone, I will just sign off now.
Yes, sir.
Thank you. I will end.
Thank you so
Verma
much,
sir,
sir.
thank you once again, sir. Thank you,
Thank
बहुत बहुत शुक्रिया, sir. Thank you. Thank you, sir.
Thank you, sir.
Thank you, Pradeep ji. Thanks a
Thank you.
lot.
Bye.